Most people think that to see real financial change, you need hundreds of thousands or even millions of dollars. That's the story we're told. College graduates are warned about debt. Financial advisors talk about retirement portfolios. And everywhere you look, the message is clear. Real wealth takes decades and enormous sums. But here's the truth. There's a hidden tipping point, a number where your money stops being a collection of paper and numbers in a bank account and starts working for you in ways you never imagined. That number is $20,000. $20,000 is not $50,000. It's not $100,000, and it's definitely not a million. But $20,000 is the threshold where your financial life, your freedom, and even your mindset begin to transform. Say it out loud, $20,000. For most people, that sounds like a lot. But for Wall Street traders, venture capitalists, or even some finance gurus, that's small change. $20,000, they might laugh. That's just a tip at dinner. And yet, for the average person, $20,000 is the hardest, most decisive sum of money you will ever accumulate. It is the first threshold that separates survival from strategy. Before it, every financial step is a battle. After it, every dollar begins to work for you. Most people operate under the belief that until you have six figures, investing, buying property, or growing wealth is impossible. That thinking is not just wrong, it's dangerous. Imagine trying to climb a mountain while carrying a backpack filled with bricks. The mountain isn't taller, the burden is heavier. This is what happens when people wait for a perfect financial moment to start saving or investing. In reality, starting small and reaching $20,000 is more important than aiming for $100,000 from day one. Consider a simple scenario. You start with $50 a month. That's it, 50 a month. Over the course of 5 years, with consistent saving and moderate growth, that tiny habit can become $3,000, $5,000, even $10,000. And once you reach $20,000, the rules change. Momentum replaces struggle, opportunity replaces fear. Your money begins to amplify itself. Before $20,000, every financial decision is emotional. A car repair, a medical bill, or an unexpected rent increase feels catastrophic. After $20,000, the same events are inconvenient, but they are not life-altering. The abstract concept of $20,000 becomes real when we look at stories of people who reached this threshold. Sarah, a 28-year-old graphic designer, had $5,000 in savings. Every month, she would put aside $300 investing in low-cost index funds. For years, the money grew slowly. She resisted lifestyle inflation. No new car, no expensive vacations. Then, after a few years, she hit $20,000. Sarah didn't buy a luxury apartment or a sports car. She bought confidence. She started pitching higher-paying clients, taking on freelance projects she had previously avoided because of fear. Her mindset shifted. She wasn't just saving anymore, she was building. Mike, a college student, had $1,000 in his bank account. Through careful stock investing and research, he turned that $1,000 into $20,000 over 3 years. The money wasn't even the most important part. It was the freedom that came with it. For the first time in his life, Mike could make decisions based on strategy instead of survival. He could say no to side hustles that didn't matter, prioritize opportunities with real growth, and finally, see the long game. James, a real estate beginner, used $20,000 as leverage for his first down payment. That $20K all unlocked an opportunity that had been out of reach. It didn't just buy property, it bought access to wealth building pathways that are invisible to those without capital. These stories all share a common thread. $20,000 changed the way they interacted with money, risk, and opportunity. There are three primary reasons why $20,000 is a tipping point. Asterisk 1. $20,000 is a tipping point. Compound growth accelerates. When your principal is small, compounding barely matters. $2,000 earning 8% per year generates $160. That's a small return. But $20,000 earning 8%? That's a $600 per year. Suddenly, your money starts to make an impact. Compound interest is a slow engine. It doesn't produce fireworks overnight, but it builds a machine that can turn modest savings into significant wealth over decades. The key is critical mass, and $20,000 is that critical mass. Asterisk 2. Access to better opportunities. Some investments simply aren't available until you hit a threshold. Certain real estate deals, private stock opportunities, and side ventures require capital. $20,000 is often the minimum to unlock these doors. Below it, the world of high-yield opportunities remains inaccessible. Asterisk 3. Psychological shift. Perhaps the most important reason $20,000 changes your brain. Scarcity consumes mental bandwidth. When you live paycheck to paycheck, every decision is stress-laden. You can't think long-term because survival is urgent. $20,000 doesn't just give you money, it gives you breathing room. Suddenly, your brain switches from survival mode to strategy mode. You can plan months, even years ahead. You can evaluate opportunities rationally. You can negotiate without fear. You can say no. Even with the best intentions, most people fail to reach this milestone because of three common mistakes. Spending every extra dollar, a raise appears, and it disappears immediately. Chasing big gains too early, risking everything on hype-driven schemes instead of building a foundation. Ignoring compounding, trying to hit large milestones with erratic effort instead of steady accumulation. The solution is simple in theory, but requires discipline. Track your net worth, budget consistently, start micro-investing, and avoid impulsive spending. Start small, stay consistent. Save $5,500 per month. It doesn't matter if it feels insignificant, consistency is what compounds over time. Reduce lifestyle inflation. Don't upgrade your car, phone, or apartment until you've hit $20,000. Resist societal pressure. Reinvest gains. Compound interest is the silent engine that grows your money. Explore higher return opportunities once you hit 20K. Index funds, real estate, and side ventures become viable at this stage. Optional exercise. Calculate how long it will take to hit $20,000 at your current savings rate. Be honest, it's the first step toward accountability. Once you hit 20K, everything changes. Your money is no longer just a buffer. It is a tool. You can invest strategically, pursue higher risk opportunities, and even leverage that capital into real-world assets. The psychological transformation is equally profound. Fear stops dictating your choices. You move from being a saver who reacts to crises to a strategist who designs your life. The stress that comes from scarcity diminishes, patience improves, and decision-making quality skyrockets. You think in months and years, not day to day. You stop gambling on luck and start building deliberately. You gain confidence, freedom, and a new sense of control. Stays. This is where most financial content stops. Save your money. Invest in index funds. Be patient. But you deserve more than a generic roadmap. You deserve a real strategy, one that treats your $20,000 with the seriousness it has earned. Here's how to think about deploying your $20,000 like a deliberate investor, not a hopeful saver. The bedrock of any serious wealth building strategy at this level is low cost, diversified index funds. This is not glamorous advice. It is, however, the most reliable vehicle available to the average investor. An index fund tracks a market index like the S&P 500, which represents 500 of the largest companies in the United States. When you invest in an index fund, you are not betting on a single company, you are betting on the entire engine of American business. Historically, the S&P 500 has returned an average of roughly 10% per year over the long term. Put $10,000 into a low-cost S&P 500 index fund through platforms like Fidelity, Vanguard, or Schwab. Set it on automatic reinvestment. Then do the hardest thing an investor can do, leave it alone. At 10% annual growth, that $10,000 becomes approximately $25,900 in 10 years. In 20 years, it becomes $67,000. In 30 years, it approaches $175,000 from a single $10,000 investment. That is the power of patience and compounding working together. Beyond the S&P 500, consider also allocating a portion to international index funds and bond index funds. International exposure protects you if the US market underperforms, and bonds provide a stabilizing counterweight during volatile periods. A simple allocation might look like this: 70% S&P 500 index fund, 20% international index fund, 10% bond index fund. This is not a rigid formula. It is a starting framework. Once your foundation is in place, you can begin allocating a smaller portion of your capital to individual stocks. This is where you accept more risk in exchange for the potential of higher returns. The key word here is research. Investing in individual stocks without research is speculation, not investing. Before buying a single share, ask yourself 3 questions. First, do I understand what this company does and how it makes money? Second, has this company shown consistent revenue and earnings growth over the past 5 years? Third, is the stock reasonably priced relative to its earnings? Meaning, does the price to earnings ratio make sense? A reasonable approach is to allocate no more than $3,000, $5,000 of your $20,000 to individual stocks, spread across 3 to 5 companies in different industries. Concentration in a single sector is a risk multiplier. If technology collapses and all 5 of your stocks are tech companies, your portfolio collapses with it. Diversification across sectors, technology, healthcare, consumer goods, energy, and financials reduces that risk meaningfully. One practical strategy for beginners is dollar cost averaging. Rather than investing $3,000 all at once, invest $300 per month over 10 months. This removes the pressure of trying to time the market perfectly, a game that even professional fund managers consistently lose. You don't need to own physical property to invest in real estate. Real estate investment trusts, or REITs, allow you to invest in real estate portfolios the same way you would buy a stock. REITs are legally required to distribute at least 90% of their taxable income to shareholders as dividends, which means they are excellent income-generating investments. With $20,000, you can begin building a REIT position that pays you quarterly dividends, passive income that grows over time. Consider allocating $2,000, $3,000 here. Look for publicly traded REITs in sectors with strong long-term demand. Residential housing, healthcare facilities, and industrial warehouses are all areas where demand is driven by structural trends, rather than short-term speculation. REITs behave differently than stocks. They tend to be more sensitive to interest rate changes, but less volatile than individual growth stocks. Adding REITs to your portfolio introduces an income stream that works independently of market performance. This is the investment most people ignore entirely, and it is the one with the highest potential return of all: investing in yourself. Take $1,000 or $2,000 of your $20,000 and direct it toward a high-value skill that directly increases your earning potential. A certification in data analytics, digital marketing, financial modeling, or coding can translate into a $10,000, $30,000 years. That is a 500% to 1,500% return. A number no stock market investment can reliably match. The logic is simple. Your biggest wealth building asset in your 20s and 30s is not your savings account, it is your income. Every dollar you earn from enhanced skills compounds into your investment accounts for decades. Treat skill acquisition as a financial instrument because it is one. No investment strategy is complete without a protected reserve. Keep $5,000 of your $20,000 completely untouched in a high-yield savings account. This is your financial moat, the wall that prevents a single emergency from dismantling everything you have built. High-yield savings accounts currently offer meaningfully better interest rates than traditional savings accounts. Your emergency fund is not just sitting idle, it is earning returns while remaining accessible. The psychological value of this reserve cannot be overstated. When your car breaks down or a medical bill arrives, you do not have to sell investments at a loss to cover it. You do not panic. You do not derail your strategy. You write the check and move on. The most dangerous moment for any new investor is right after reaching $20,000. The temptation is to feel done, to stop the disciplined saving habits that got you there, and enjoy the milestone. Resist this completely. $20,000 is not the destination, it is the launching pad. The habits that built your first $20,000 are the same habits that will build your next $20,000 and the $20,000 after that. Keep your monthly contributions alive. Set up automatic transfers into your investment accounts. Treat investing as a bill you pay yourself before anything else. A person who reaches $20,000 and stops contributing will plateau. A person who reaches $20,000 and keeps contributing will accelerate because now their compound engine is running on a real base of capital. And every new dollar added amplifies its returns. When you reach $20,000, you're no longer playing defense. You can start playing offense. Bulletproof your life. Keep 5,000, 10,000, 10,000 untouchable for emergencies. Invest for growth. $10,000, 15,000 can go into diversified index funds or other low-risk investments. Invest in yourself. $1,000 in courses, skills, or certifications can offer outsized returns on your personal growth. Avoid the common traps. Do not borrow to invest. Avoid complex derivatives. If you don't understand it, it's a trap. Do not use $20,000 for lifestyle inflation, like a car or luxury purchases. Preserve freedom. $20,000 is your snowball base. With consistent effort and patience, it will double and quadruple, eventually providing access to six-figure growth. True wealth is not measured in cars, yachts, or luxury watches. True wealth is waking up knowing that you are in control. $20,000 buys back rationality, patience, freedom, and dignity. It reduces stress, improves sleep, and protects mental health. It allows you to live with choice rather than scarcity. When you have $20,000, you are psychologically richer than someone in debt driving a luxury car. You can focus on life instead of merely surviving it. Write down your current savings. Decide what sacrifices you will make. Coffee, shopping, extra work hours to reach $20,000. When you hit that number, 3, 5, or 10 years from now, return to yourself and say, I did it. Because at that moment, you haven't just changed your savings, you changed your life, your mindset, and potentially your family's financial destiny. The first $20,000 is the launch pad. The game has started, now go win it.